Trading the bear market. If you don't know what those wild gyrations on your screen have been lately, that is called a bear market. And while rare, they do occur, and we're certainly in the middle of one now, and maybe even the beginning. Who knows what's going to happen next? So why listen to John Thomas? Well, I have 55 years of experience in the global financial markets, 10 years as the economist correspondent in Tokyo, Japan, and later the White House, 10 years running the international equity division at Morgan Stanley, Marine Corps combat pilot in Desert Storm, 10 years running the first international dedicated hedge fund, 5 years fracking for natural gas in Texas, and now 17 years publishing the Diary of a Mad Hedge Fund Trader. I am one of a handful of founders of the modern hedge fund industry who's still breathing and working. So take out your pen and paper to take notes. What I'm about to tell you will blow you away and change your life, for I'm in the early retirement business, your early retirement. Learn what to buy, when to buy it, and why. There is a method to my madness. The market currently is looking through a trade war solution, assuming that no matter how bad the trade wars that have been announced so far, eventually they will get solved. Or at least that's what the market thought for the last 2 weeks when it was rallying off a extreme low. Bonds are stabilizing after seeing the worst trading week in 25 years on a promise that the president will not fire Jay Powell. Markets have entered a wide trading range with much volatility, lots of opportunities to make money here. Economic data remains consistently weak, capping any upside in stocks, and we certainly saw that today. Recession call is still on, with China in no hurry to negotiate. It's safe to say that when the U.S. doesn't know the name of the person they're negotiating with, they're not negotiating with anybody except themselves, or maybe the stock market. That's who they're negotiating with. U.S. dollar hits a 3-year low on a sell America trade. Oil bounces off 4-year lows, but is another big recession indicator right now. Gold remains golden at all-time highs. We've had a 6% pull off. Get ready to get back into gold again. So the economy absolutely is awful. The Beige Book says we're in stagflation. Jay Powell hints there won't be any interest rate cuts this year, because inflation is too high. Consumer confidence is posting 20 and 30-year lows. IMF cuts the U.S. GDP forecast. Leading economic indicators plunge. Europe lowers interest rates, and they've lowered rates now 7 or 8 times against no cuts for ourselves. Unemployment fears hit a 5-year high. Inflation expectations are at 44-year highs. Yes, it all looks like a horror movie. So how would you like to earn 350% in a month? How about 394%? If that doesn't work, how about 412%, 421%, 811%? These are all the returns that Mad Hedge followers have gotten from our trade alerts, and I'll tell you how to do that in a second. So the election, as we all know, had consequences. It brought us an earlier but higher stock market top. That's behind us now. It brought us a recession. That's happening now. It brought us a much lower level in a market crash than we could have thought. That's in progress now. It's still a coin toss whether we go to new lows or not. There are more sectors that are losers in the economy now than winners. Inflation is rising, stagflation, national debt is rocketing. We're going to have less regulation at some point, at least it's been promised, that will affect financials, full self-driving cars, and crypto. Environmental protection is doing a disappearing act, and we soon will have extreme labor shortages at minimum wage levels, hitting agriculture, restaurants, and construction. Oh, and they have this new thing called import tariffs. Yeah, I bet you've heard about that. I've been through quite a few trade wars myself. For most people, this is a new experience. So why follow Mad Hedge Fund Trader? Well, we've averaged 50.61 for the last 17 years versus 22.92% for the S&P 500. This is us in the blue. That's the SPYs in the orange. And notice that even when markets go down sharply, like we've seen this year, we go up sharply. We make money in all market conditions. And if you don't believe me, just listen to one of my clients, Wilson. Let's see if I can get his.
Hi, my name's Wilson, and I've been with the Mad Hedge Fund Trader and John Thomas since 2019. I caught the phenomenal returns in 2019 and 2020, somewhere in the order of the 80–90% returns on both of those years. I caught all of those trades, NVIDIA, the TLT, the Teslas, and so many more. And then in 2021, I started trading in some additional accounts, and I have caught almost all of those trades as well, and have been getting almost the entire returns that John has received, and it's been just fantastic.
All right, Wilson, and just to recap here, these are the actual trades that Wilson was able to accomplish. He actually sent me his account statements to prove it. 482% on NVIDIA, 811 on NVIDIA again, Berkshire Hathaway 421, JP Morgan 412, Palo Alto Networks 394, Vertex Pharmaceutical 350, Silver 113, and JP Morgan again 87. Of course, the stocks didn't move anywhere near this much. We did get these returns by using very sophisticated option strategies which minimize your risk and maximize your returns. And it has been working great for us for 17 years now. Personally, it's been working for me ever since the options markets opened 50 years ago. So this is my secret weapon, the Mad Hedge Profit Predictor. That's my market timing index. Today it's showing a reading of 57, meaning we're getting somewhat overbought. When we get all the way up to 80, that's a panic sell level. When we get down into below 20, that's a buy level. And of course, we spend all year going back and forth like this. This is great for market timing. It took a team of a team of mathematicians 1,000 hours to come up with the algorithm that powers this. So why do you need an algorithm? Well, why use a toolbox missing its most important tool? Algorithms have become so dominant in the market, you should never trade without one. It does the work of a seasoned 100-man research department in seconds. It runs real time and optimizes returns with the addition of every new data point far faster than any human can. Imagine a trading strategy, it upgrades itself 1,000 times a day. Don't go to a gunfight with a knife. If you're trading against algos alone, you will lose. Algorithms provide you with a defined systematic trading discipline that will enhance your trading profits. This is 3 years of market timing signals. And you can sell, we get a lot of buy indicators at market bottoms, sells at market tops, buy, sell, and that's how you make 50% a year return on average. I'm not the only one using algorithms. Some 80 to 90% of all current trading is algorithm driven. I was walking on the Miami waterfront a few years ago, found this super yacht, and look what it's called, algorithm. Obviously, it's working for more people than just me. This is the trailing 1 year of signals, buy and sell signals, and you can see this was the August meltdown, where we had a very sudden collapse in the market. Huge buy signal right here, another one right before the election, and then we got another one here on April 2nd. And since then, we've melted up about 15% in the index. Also giving you sell signals here, 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 and here. This year has really been about sell signals. So, why cover all asset classes? Sounds like a lot of work to me, which it is. Information about one asset class sheds light on all the others. For example, knowing what the bond market's going to do and therefore interest rates is incredibly useful advantage when picking stocks. Some asset classes will be doing great while others are dead in the water. It will point you to where to trade the winners and avoid the losers. Give yourself every advantage. Knowing what's happening all the time, everywhere, is the way to do it. So, how to trade a bear market? I've been through quite a few of these. I should count them someday. I think I've been through at least 12. Uh, and it is an art form in its own. We're going to tell you how to do it. So for a start, um, there are inverse S&P 500 ETFs, which do the exact opposite of what the S&P 500 is doing. It's great to hedge existing portfolios, or you can just do directional trading on your own. And you can see when the market peaked right here on February 18th, uh, this index was just trading just above 18. We made it all the way up to 28. That's over a 40% gain in just 2 months. And of course, once we got the 90-day postponement on the tariffs, it collapsed back down again. So huge volatility, huge moves, and we're getting close to buy territory right back down here again. There's also, if you're not happy with a 2x ETF, about a 3x short ETF. And that's exactly what this one does, the SPXU. And this one moved from just over 18 to 38, and that is more than a double on literally only a 20% move in the index. So again, huge moves over a short period of time, fantastic trading vehicle, fantastic hedging vehicle. You can also buy put options on specific stocks, and here I use the example of Apple. If you could buy the $200 puts today at 17, which expire in December of this year, and it collects $100 for each dollar Apple falls below 183, which is your break-even cost on a 17 cost. So again, another hedging vehicle, very simple, kind of expensive. There are better ways to hedge, but I just thought I'd start at the beginning first. You can also sell short call options. These are also known as buy rights, and people have been doing buy rights and doing extremely well, really since December. If you use every rally to sell a front month call option short against your long Apple position, you're doing quite well this year, and you're probably even up on your Apple position, even though Apple has dropped $60. And all you had to do was write calls here, let them expire, write them again here, write them again here, write them again here, and oh, how about writing them right here? In this example, if you sold short a $200 call option, expires in December, you make $22, and you collect $2,200 for each option you own, as long as it stays below $200, the strike price. There are also a lot of dedicated ETFs that take advantage of specific market indexes. For example, you can buy volatility, and there are many ETFs that do this. In this particular one, let's go back to the February 18th peak in the market. You can see the volatility index of the VIX went from 17 to 60. That's quite a move, a fourfold move. And if you were long volatility in any form, they also have 2x and 3x ETFs on this. You made quite a bunch of money. It also turns out that initial public offers, stocks that recently went public, dropped twice as fast as the main market in bear markets. And you can see here you could have shorted the IPO ETF here at 48, and it went all the way down to 31. So again, big dip there, great way to play short up here. Also, another opportunity you can take advantage of, momentum dies in bear markets. Well, why don't you short momentum? Well, if you had shorted momentum on February 18th, this ETF went from 230 to 170. That's an enormous drop, about 25%. And if you'd covered at the bottom, you would have done quite well. And by the way, we're very close to another place to sell short the MTM once again. There's another one. You can short beta. The beta in a stock also collapses in bear markets because a lot of stocks collapse and then stop moving. They just sit around the bottom forever. And in this particular case, you could have sold short the Invesco S&P 500 high beta ETF, could have sold it up here at 96. It went all the way down to 60. So again, other great short plays outperform any falling market. Here's another one. You can buy specific hedge funds which play long and short the market. And this particular one, the HDGE, had a fantastic return, went from $15 up to 20 before selling off. That's a 35% return, and is another great way to hedge existing stock portfolios. And when all else fails, you can go cash. But there's cash and then there's cash. And the best way to keep your cash is in 90-day US Treasury bills. By the way, Warren Buffett owns over 300 billion of those, so he likes them. You know, for a start, the 90-day T-bill is government guaranteed, has endless liquidity. They trade like water. It has 100% collateral value so for margin. So if you're trading short term, you can keep all your money in 90-day T-bills and then buy new positions in other stocks on margin against them. Margin interest rates these days are around 5.5%. So it's not costing you very much to take on a new position. You lock in a guaranteed income. You know exactly how much you're going to get at a certain point in time. You can sell it anytime you want to earn full interest. By the way, the interest isn't taxable until you sell it. So if you buy 90-day T-bills, or if you buy 1-year T-bills, for example, they expire next year, the tax isn't due until next year or the year after when it's payable. These will survive any bear market. It's basically bomb-proof, but they don't make it easy how to buy them because brokers don't make money selling 90-day T-bills. They make money selling stocks. So you may have to call them and ask them how to actually get a hold of these things. So stocks, we have been on a roller coaster to say the least. We've had the worst start to a year in market history, and that's going back to when the Dow average was started in the 1800s. But we are at all-time valuation highs at a price earning multiple of 22. Morgan Stanley is marking down its forecast from S&P 500 earnings from 270 share down to 257. Volatility index spiked up to 54, then collapsed. All capital gains of the last 13 months were wiped out when we were at the market lows. Chaos reigns supreme with gigantic 1,000-point moves almost every day. Hedge funds are still dumping technology stocks, using rallies like this one to go short. And tech stocks are still expensive relative to the main market, but nowhere near as expensive as they were just 3 months ago. So that is why technology is leading the downturn on every down day. The tech stocks always fall the most, and today was another good example of that. All long-term technical indicators have rolled over, showing that the bear is here to stay for the foreseeable future, could continue through the summer, even into next year, if the economy really goes down the tubes. So all in all, 2025 is looking like a down year for stocks. We'll have some kind of a negative return. If we're lucky, we'll rally all the way back up to -1 or 2% instead of the -22% that we are at, or the -30%, which is possible by this summer. So this is the SDS here, and we already covered all these, so I'll skip through those. So this is our new range, down 5.4% from the high in February to down 20% from the February high, or 5,000 to 5,500. There's a lot of hedge funds that are zeroing in on that range, and you can see why. This is the high here at 580, the low which we got in the beginning of April, down here 480. That is a very generous range to trade into. Best case, we keep trading in this range until the recession fears pass. Then we take off and go to new all-time highs next year. Worst case, we keep trading in a range, and then, oops, trade war didn't really quite work out, and we break down to new lows, at least down to 4,000. There are a lot of technical indicators targeting 4,000 on the downside now for the SPYs. So what to own? On bear markets, if you're a long-term investor, you want to use the opportunity to buy Cadillacs at Volkswagen prices. And JP Morgan is certainly one of those. They are the quality play in banks, and they do have the advantage, and they will be a big beneficiary of deregulation if and when that happens. Citigroup, same category. Berkshire Hathaway, well, we had a slight change over the weekend. Warren Buffett retired. That took us all the way down to the bottom end of this range today. Berkshire Hathaway now has to reprove its leadership once again with a new CEO. Hopefully that will be successful, and Berkshire will continue to be the great play that it has been for 60 years, really. And we've had this as a core holding since we started Mad Hedge Fund Trader 17 years ago. So another buy on the dip. Goldman Sachs, another bank, benefiting hugely from the tremendous volume in the market right now. And we're targeting $700 a share in 2026 for Goldman Sachs. Morgan Stanley, another broker with a very hefty presence in asset management, which I helped set up myself about 40 years ago. We're targeting 180 for next year for Morgan Stanley. And BlackRock, another money manager, we're looking for 1,200 after they've had a big sell-off this year. Interactive Brokers, another big options trader, benefiting hugely from the volatility and the volume. I'm looking for $300 a share next year in Interactive Brokers. Second half of the barbell are technology plays. And of course, there's the index, NASDAQ. And it has almost recovered to where it was a couple of months ago. Again, looking for a trading range down here with an eventual upside breakout. Tesla, I think, also stays in a trading range for a while, possibly for all of this year. Eventually, I do see an upside breakout hitting next year, 2026 target of $460, and there's me with the new Cybertruck down there. And Microsoft already had a monster move last week on earnings surprise and continuation of AI investment. So that is a pretty amazing move right there. We're looking for $500 a share next year. And by the way, these are some of the planes that I fly at air shows. I'm a part-time pilot and a vintage aircraft pilot, and all these planes are older than I am. This is a B-17, Boeing B-17 bomber. Metastock, again, looking for it to recover by next year, $700 a share by 2026, and that's me with a B-24 Liberator. Amazon, subject to antitrust proceedings, also caught in the trade war, bouncing around its summer lows of last year. We think it does recover at some point, and we're looking for $300 a share there. That's a B26 Marauder down in Florida. And NVIDIA, probably the largest stock held by most individual investors, also the most overowned. We've been shorting it like crazy, selling here, 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 and here. We sold it again this morning, but we expect a recovery next year up to $180 a share once a recession ends. And Alphabet, um, again available at bargain prices, looking for a recovery next year to 250. When this recession ends, you can expect the leadership to be in two sectors: big technology stocks and banks. Those are our two favorite sectors. Until then, there's a lot of other things you can do in the markets, and that's an early P-51 Mustang fighter, fabulous plane to fly. Palo Alto Networks, of course, hacking never goes out of style, and we're looking for 250 a share by next year. Palo Alto Networks, and this is a B-25 Mitchell bomber. This is the one that did the original raid on Tokyo. Okay, bond market. Yes, you can make money in bonds. Actually, not a bad year to own bonds because they're paying interest about 4.3% at the moment for the 10-year. But bonds have had to put up with very heavy selling by foreign central banks, and that's because the U.S. Treasury discussed hitting foreign investors with withholding taxes on their U.S. Treasury bond holdings. That caused a panic, which took bonds down 10% in 1 week. And so far, that never got out of the discussion level. So we have had some recovery, but not much. Bonds had their worst sell-off in 25 years, and no one's rushing back in. Continued collapse of the U.S. dollar is scaring away foreign bond investors. Even if bonds are unchanged this year, foreign investors are losing 20% just on the currency. Bond credit quality is crashing, so I would avoid all interest rate plays for the time being. Here's the TLT. I say that monster crash back here, struggling to get up, but not really happening yet. So I'm going to stand aside on bonds for the time being. Here's interest rates. Those seem to be headed towards 3.5% by next year, but the Fed may not cut interest rates until next year because of rising inflation fears. So don't expect much of a move to happen until then. Foreign currencies, the dollar is trash. Dollar's had some of the sharpest down moves in history since the beginning of this year. As the flight from America trade accelerates and foreign investors pull their money out, not only in stocks and bonds, but in real estate and everything else. Rising interest rates haven't helped. Usually rising interest rates are great for a currency. It's not happening. That means the weakness in the dollar is structural. It's not temporary. 15 years of long dollar positions held by foreigners are now unwinding. Trump economy is forcing investors to flee all U.S. assets, including stocks and currencies. Massive cash flight is running away from the U.S. and going predominantly into Europe and Japan by all the foreign currency ETFs. There's a lot of them out there. Australian dollar, after that one meltdown week, we've since had a nice 10% rally. I expect it to go higher. And the Japanese yen up about 20%. Fantastic play. Euro has been one of the strongest also. Huge moves here. And the British pound also. Who thought the British pound would ever be back in favor anywhere? But it certainly has been since the beginning of this year. And of course, emerging market currencies also doing very well, as a lot of foreign trade moves out of China into other emerging countries. Energy and commodities have just completely crashed. One of the biggest down moves in history, down $13 in a week or 18%, 72 down to 59. It's traded even lower since then. Even high dividend paying stocks collapsed. ExxonMobil was down 18%. It is the sharpest fall in Texas tea since the 1991 Gulf War. Recession fears are running rampant. No one wants to pay for a storage until a recovery, which may be years off. Oil is very expensive to store because of the contango. You have to pay for the storage and you have to borrow the money to pay for it. Global recession is looming large. Avoid all energy plays like the plague. And here is my long-term forecast. This is the oil going out of style chart. And you can see we've had one of the biggest double tops of all time. This one back in 2002, this one again in 2022. And eventually I think oil goes down to $10 a barrel, but it may take 20 or 30 years to get there. So definitely a losing commodity while all the others are rising. Cameco is one area in the commodity space which we really like. They are makers of fuel for nuclear power reactors, known as yellow cake. Great double bottom setting up down here. I'd be looking to buy anywhere down here, and you could easily get a large move in that, maybe up to $100 a share. Precious metals has been taking a break, but boy, it has been the place to be in 2025. At the highs, it was up 40% so far this year, made it up to $3,500 an ounce, and JP Morgan is targeting $4,000 an ounce this quarter. Gold topped its inflation-adjusted all-time high from 1980 at $3,424 an ounce. Interest rates seem to no longer be a factor. It's just flight to safety. It used to be that high interest rates were bad for gold. That's just not happening this year. And we're starting to see the first $100 up moves in history in gold. We've already had a couple of them this year. So natural profit taking is taking gold back to 5%. I'd be getting in right around here. Start scaling in. The central bank buying that's been supporting gold for the last 10 years never really went away. So keep all gold plays and miners on dips. So here is the gold chart. This is the GLD ETF that trades in US markets. And my 3-year target is $5,000 an ounce, or up 66% from here. Also looking at Barrick Gold, world's largest gold miner. We're looking for a 60% gain this year from here. So yeah, lots of upside for Barrick Gold. Same with silver. You know, silver is going to play a catch-up game with gold because there's a real shortage of risk-off asset protection plays around the world right now. So the harsh truth is you really need my help. The majority of individual traders lose money. They lack the correct training and discipline to succeed. Most broker research suffers from grievous conflicts of interest. Wall Street is all about moving money from the uneducated to the educated. The easy solution to that problem is to get educated. Fidelity did a 20-year study and learned that their top performing investors were dead people. Why do dead people do so well? Because they never sell. You need a real pro to guide you through the market maze. The market is not monolithic, and 95% of it can be completely ignored. There are a few great sectors and a lot of awful ones. You can earn a 10 times return on the great ones, but get wiped out by the losers. Let a 55-year veteran steer you to safe waters. Let me sit next to you and guide your hand on every winning trade. 89.74% is our trailing 1-year return, and we're at an all-time high right now. Richard made millions religiously following my trade alerts. He now spends his retirement restoring vintage aircraft and flying them over the California coast. Greg turned $100,000 into $3 million solely on my trade alerts. He bought a new home in Orange County, California, with Tesla solar panels, a Tesla Powerwalls, and a Tesla Model 3. Still has enough money to send 3 kids to college. And let's hear from my friend Bob, who turned $500,000 into $27 million.
Hi, this is Bob. I live near Denver, Colorado, and I'm hiking on top of the Continental Divide. 9 months ago, I joined John's global dispatch service and was so impressed with the profits I made that 2 weeks ago, while hiking in the Dolomites, I joined his concierge service. And in 2 weeks, it is 100% paid for it. And I couldn't be happier. Life is good. John really helps. The other day, I had a text message exchange with him regarding some concerns I had with TLT. Put spreads, he encouraged me to stay in. I did, and today they went out at 95% of maximum potential profits. And that's the way it works for me. I hope you all do well trading yourselves. Thank you.
Thank you, Bob. So what do we do about all this? Well, stocks, you want to sell rallies. Bonds, you want to buy dips, but only the biggest dips. Commodities, buy dips. Energy, sell rallies. Currencies, buy dips. And precious metals, buy dips. If you're not up 89.74% in the past 12 months, as I was, you're reading the wrong newsletter or following the wrong trade mentoring service. 50.61% average annualized return. You get those kind of returns, you get to do things that other people can't do, like take the owner's suite on the Queen Mary from New York to England. And once you get to England, you can take the Orient Express to Venice. Here's the very long view. The 2000s and 2010s were the hard decades for making money. The 2020s and the 2030s will be the easy ones as a global demographic wave brings on a new golden age. 85 million millennials will become big spenders over the next 15 years, while 80 million baby boomers, a drag on the economy, will fade from the scene. That would create an economic boom that will last another decade, and that started in 2023. Up 20 times in 18 years. Are you ready for a replay? That is what happened the last time we had an identical demographic tailwind like this one. Up 20 times from the 2009 low takes us to 120,000 the Dow by 2030. And if you think I'm smoking California's most popular product, think again. We're already 3/4 of the way there. We only need one more triple to get to that 120,000 target. So, except this time it's different. We have an AI tech turbocharger, which is hyper accelerating on all fronts simultaneously. AI-based products and services are just starting to roll out. The development of functional quantum computers means that computational ability will be about to increase 1 trillion-fold at no cost. So who will show you how to play the next 90,000 Dow points? Sit with me, John Thomas, the Mad Hedge Fund Trader, and my Global Trading Dispatch. Follow my research and market-beating trade alerts, and you can rake the profits in. Let a Marine combat pilot steer you to big profits. We trade single stocks, options, and ETFs for global equities, bonds, foreign exchange, energy, commodities, precious metals, and real estate. This is a typical month for us. We bought the S&P 500, made a 16% profit. We had 10 out of 11 trades make money that month. Bought the TLT, bought the Russell, bought Amazon, bought Apple, bought Biogen, but then stopped out very quickly. We have a very aggressive risk control process where we stop out of losers very quickly. Easy to do when you know 90% of the time your next trade is going to be a winner. It's just a matter of time before barbell stocks break out with all new all-time highs. Watch this space melt up going into 2026. Get ready to start reeling in those whoppers with Global Trading Dispatch as your guide. This is how it works. Our algorithm identified an upside breakout coming for NVIDIA last year. So what did we do? We sent out a trade alert, which looks like this. This is buy NVIDIA at 480 or best, and these are pre-split prices. And to get a $10,000 weighting, you needed to buy 21 shares. What happened? Well, NVIDIA went up 45% in 22 trading days. Did we sit around and relax? No, we didn't. We sent a trade alert that says take profits. Sell NVIDIA at 695 or best. And on this trade, we made $4,515 in just a few weeks. So this is a history of our 10 baggers, stocks that went up 10 times after we recommended them. There was Zoom, it went up 10 times. Lam Research, 10.6 times. Square went up 25 times. Moderna went up 40 times. NVIDIA up 70 times. And of course, the big daddy of them all, Tesla, went up 178 times from our $2.35 split adjusted price. I gained financial independence for life, and so can you. Discover how to make thousands of dollars a year in extra income. Go from complete beginner to seasoned pro in weeks. Learn how to quit your day job and trade for a living full time. Trade from anywhere, anytime. Supplement your retirement income with the satisfaction of booking winning trades by the hundreds. With my Mad Hedge Global Trading Dispatch, you get instant trade alerts sent out at market sweet spots, live biweekly strategy webinars like this one, invitations to strategy luncheons around the world, more educational videos and webinars than you consume in a lifetime, and access to a 17-year database. This is the one-stop shop. It's for individuals who understand what's happening with their retirement funds. It's for people who want to learn how to trade for a living full time, get the financial education of a lifetime. It's for small institutions and financial advisors who can't afford in-house research departments. Get in before the next melt-up begins. This is what you get in your inbox every morning, 5 days a week. A research report on the most interesting parts of the market. You also get Mad Hedge Hot Tips, the 5 most important things that happened today and what to do about them. This is what I'm not going to charge you for this service. I'm not going to charge $100,000. That's what I charge my big hedge fund clients. They're happy to pay because I make them millions of dollars. And I'm not going to charge $12,000. That's what I charge my concierge customers for this service, who can get my personal cell phone number. And I'm not going to charge $3,500. That's what the full price is on the website for our service. This is the real deal. Creating this product cost me millions of dollars. With the best customer service in the industry, running it costs millions more. 6 months for just $997. That is a 71.5% discount to the website price. We only take 25 new subscribers at a time, so it's first come, first serve. I can't wait to make you a top drawer trader. Let me make the money for you to pay for your own subscription. You make the trades. Discover how an experienced hedge fund manager finds and exploits the best sweet spots in any market. Just click on the chat box on the right. Buy now and you'll instantly receive a trade alert with an extremely high probability of success that you can execute immediately and make some of the most serious money in your life. 90% of these trade alerts make money immediately. So sign up today. You'll also get my video training course, Options Trading for Beginners, a 12-chapter course about everything you ever wanted to know about options, written for the basic beginner. So we just have a couple of minutes left. Who is John Thomas? Grew up in LA, the oldest of 7 children. Wasn't much to do in California in the old days. So I became a paper boy and found the stock pages, bought IBM at 20 and sold it at 30, and slowly found a far better way to make money than delivering newspapers. By the time I was 16, I earned enough money to fly to Europe. By the time I was 17, I'd visited 50 countries and spoke 4 languages. At UCLA, I majored in math and DNA research, which landed me a job at the nuclear test site in Nevada. As the war wound down, I became a foreign correspondent for The Economist magazine, and after 10 years of government service, all I ended up with was a bunch of medals. As a foreign correspondent, I covered China during the Cultural Revolution, was the first American reporter to visit North Korea since the Korean War, and covered the rest of the continent all the way to India. I figured out very quickly you didn't have to be that smart to make money in the stock market. So I got into the industry, joining Morgan Stanley. And yes, the years have been cruel. That's me back in 1983 with my original ID card. Served as a tank commander in Desert Storm, also flew as a pilot, and that was a great experience. Rapidly became the top performing hedge fund manager of the 1990s, eventually bringing in a 1,000% return in a decade. Then the money really started to pour in. It's an understatement to say that when your income goes from the thousands to the tens of millions, it really has a big impact on your lifestyle. I now spend my days pursuing my first love, finding winning trade alerts, but I now do it from my 3 houses in San Francisco, Lake Tahoe, and Zermatt, Switzerland. And I've quit turning millionaires into billionaires. There's far more satisfaction in leveling the playing field for the average guy and teaching them how to trade, and that includes you. If I can take a $50,000 account and turn it into $500,000, that is more job satisfaction than I can get anywhere. In the free time I have left, I fly vintage aircraft, as you probably realize by now. And as a Marine Corps veteran, I volunteer for grief counseling for widows and orphans. When you make millions of dollars for your clients, you get a lot of pretty interesting invitations. $5,000 cases of wine, lunches on super yachts, and free tickets to the Olympics. So it was in that spirit that I traveled to the famed World War II fighter station at Biggin Hill in England to meet Mad Hedge Concierge member Peter Monk. Peter was a poorly paid pilot for Ryanair when he first signed on for my global trading dispatch. After doubling his money in the first year, Peter upgraded to my concierge service. Then the money really started to come in. Peter plowed his Mad Hedge trading profits into restoring a 1940 Battle of Britain veteran, a Supermarine Spitfire Mark IX, in his backyard, begging, borrowing, and trading for parts all over the world. He eventually built his fleet up to 16 flying aircraft, which today are worth over $65 million. When Peter invited me to fly one, I jumped at the chance. It was a mild and blustery day when we took off and headed for the English Channel. Even though the plane was 82 years old, we managed a brisk 250 miles per hour over the countryside. The Spitfire could outmaneuver any plane that the German Air Force threw up against it. This particular plane is credited with shooting down 2 Messerschmitts, and it's easy to see how. We found a clear piece of sky over the white cliffs of Dover between 2 big fluffy cumulus clouds and commenced a full-on aerobatic flight test. Pilots always want to see what I can do with these old planes, and this time was no different. I executed multiple loops, barrel rolls, chandelles, lazy eights, Immelman turns, and wingovers, careful never to exceed 1G limitation or the wings might fall off. Spitfires can dive like crazy. We dropped from 8,000 to 2,000 feet in seconds. Then it was back to Biggin Hill for a perfect 3-point landing and a pint of beer. I look forward, let me make millions of dollars for you as I have done for thousands of other followers over the last 17 years. I look forward to working with all of you. And let me just check the store to see if any orders have come in. We have an order from Sheldon in Thomasville, Georgia. We have Rob from Toronto, Ontario. Thank you very much, Rob. Okay, let's move forward here. 6 months for just $997. And click on the link in your chat box to take advantage of our offer.